Hi guys, how you doing? I hope safe and healthy. My name is Francisco. First of all, thanks for tuning my YouTube channel. I want to ask you guys only just a few minutes of your time and talk about why I think Ulta Beauty is a good investment. Before we continue, I want to apologize for my English. It could be a little bit rusty. In this slide, you can read the disclaimer. This video and its content is only for educational purpose, so if you want to invest in any security, please do your own research. Well, with this presentation, I will try to answer these questions. I think they are very relevant and definitely you want to answer them before any purchase. Obviously, if you consider the value and fundamental approach, the best way to analyze a security. Well, in this slide, I can think in three main reasons why the stock is cheap. The first one is the crazy January sell-off. The second is investors are very confused about the future performance of the retail industry. And the third could be this kind of infatuation in tech stocks. I'm not saying this is a bubble or something like that. I really don't know. I think Facebook, Amazon, Google, and Apple are amazing and remarkable businesses. I hope I had them in my portfolio, but I think right now, in my view, they are really expensive related with the potential reward. First slide of qualitative research. If you don't know this company, well, this is the largest beauty retailer in the US and they sell all kind of brands of cosmetic, fragrance, skincare products, hair care products, and also they provide to their clients salon services. I think nowadays their products are kind of basic products that mostly women buy in a regular basis. The US beauty products and services is a very fragmented market. In this slide you can see a lot of different participants who compete with each other for the market share. So my humble opinion is that this is the kind of environment that you want to be because there is a lot of market share to take and problems to resolve. For example, if we compare this type of market to the wholesale auto part businesses and the sports shoes businesses that are very centralized market, so there is 3 or 4 companies that control everything, so it's very tough to participate. You have to invest like crazy to take just only 1 point of market share. That's why I think Nike and AutoZone are kind of royalty in those markets. So in this type of environment, Ulta has plenty of space to grow. We continue with this slide. Here you can understand more about the actual numbers in the US beauty products and services industry. You can see that Ulta has less than 1% of the 61 billion salon services sales, only 8% of the beauty product industry. Basically, I will argue that they got a lot of space to cover. So with the right management and tools, they could increase the sales. I will add that this new normal thing we are living in, this whole strange situation, could it's a probability, but could wipe out many small participants. I'm really very sad for them, but this could be great for the big companies, the big guys from this market. Right now, we can see the membership number. This is a key part of the business. I will say this one is the durable competitive advantage of the company, as well as the omnichannel shopping experience that they offer. They have 34 millions of active members, and that number represents 95% of the sales. We can see the uptrend in the last 7 years, so we could say that they got the correct strategy to maintain and increase the quantity of clients. So far, I think they are doing a very good job. You can see also the year-to-year growth. These are pretty consistent growth. In the following slide, you can see the population in the US. So if we only take the women from 20 to 64 years, that universe could be around 100 million or so. So I will say that Ulta has plenty of fields to sow, and that's a good thing for the company because they got a lot of space to grow. Here you can see the executive of the company. Their income is pretty common in this type of companies. I will say that it's not exaggerated, and also their intentions are aligned with the stockholder. You can see their shares. For example, if I wasn't committed with something, I wouldn't have a dime in the business. I would prefer buy something else. I think this probably is the best way to know if your team or the team is aligned with the company vision and mission. This slide represents the company last 7 years of the stock repurchase program, and basically said that the company is very interested in spent capital to increase the future per share earnings of the owners. In simple words, think of a very, I don't know, creamy and nice creme brulee, and now it's get divided in less mouth to feed, comparing with the last time. It's just that simple. So finally you will get a bigger piece for yourself. However, they announced, and I have to say this, that the repurchase program has been suspended in order to preserve financial flexibility. And I will say that maybe in 2022 they will restart the programs. So in the following slide, you can see why the strategy of the management is delivering good result for the stockholder. We can see the almost in 5 years, the earning per share were duplicated and the net sales too. We also can see that the same store sales were decreasing, but I will argue that it's a quite good performance comparing with other companies in the retail industry like L'Occitane, TJ Maxx, Target, etc. In the following slide, you can see the return on equity of the company, and it's pretty strong comparing with the average in the US business industries. I think the key in this ratio is not to have like a 70 or 80% return. It's about the consistent, and you can see the consistent here, because I think the consistent in any discipline, like business, sports, you name it, can lead you to durability, and durability means that you keep playing the game. So I will say that you got more probability of success in this type of company when the rainy days come. It's just that easy, and it's a fact that they will come over and over. So that's why the economy is not something linear. You will get bumps in the road. Well, this is another important ratio because can be used to evaluate how well a company management has utilized the total capital, including the debt. Right now is a powerful number because they don't have any debt in their books. However, they committed to 800 millions in debt in long-term debt in March 2020. So the number will be obviously less spectacular. Finally, the important thing here, again, is the same than before, is consistent. So if you have to buy a company with a 15% return on total capital in the last 7 or 10 years, I will say that you can be very confident in the future's earnings. So let's dive into the numbers. Please remember, this is not a perfect science, so numbers could change if you do your own research. Obviously, the price of the stock could be higher or lower depending on the date, but paying until 240 or so, in my view, is pretty cheap. Well, this is the scenario that I think is very likely to happen. I use an average of P/E ratio of the last 7 years and an average enterprise value EBITDA also for the last 7 years. This means that I think I could sell my stock in these multiples. Obviously, you can take the multiple that you like. I like to be conservative. You can see the yearly return. If we consider selling the stock in 5 years, the numbers are 18 and 15 compound. I think it's pretty solid. You can read my considerations for this scenario below the picture. I think they are pretty conservative according with the performance of the company the last 10 years. This is another scenario. I consider that debt will increase. As you can see, the growth will fall to 7% from 2021 to 2024. No more buybacks. Also, sales during 2020 will be 70% of the sales of 2019. I will say that it's not a good scenario, very mediocre scenario, as you can see. Nonetheless, you can make money on your investment. Let me tell you, if you have to buy this company or a 10-year treasury bond, I think the answer is pretty easy. And the last scenario is the worst of the three. You can see the considerations below the picture. Even in this type of environment, you almost get break-even. So I would say that makes you pretty safe and confident in this investment, because eventually I will not break one of my important rules, that is try to don't lose money. Almost finishing this presentation, I want to talk about volume profile and technical analysis. Look, I'm not a technical investor. My decision of purchase are based on fundamental approach, but I will say that what I like of this chart is that you can see in which prices investors participate in the best. This is related to a volume profile composite of 3 years in a weekly basis. So I think could be a great decision. Take some profit near the point of control where the most volume transact. This is the 250 or so. I think it's very important to know where you will take some profit. I like to do it when the market is giving me money. If this could happen in a year, will be almost 28% return. In 2 years, will be 13% return. In my view, this is the best situation to buy a stock, because it's when Mr. Market is selling you cheap, a robust company. Finally, in the right, you can read the main strategy that the company has for the future. So I will say that it's pretty consistent with the things that they have to do for make more money in this new normal environment. I will say that the company in the long run will be bigger, more profitable, and probably will make the stockholder happier. I want to thanks El Arte Invertir, and also special thanks to Alejandro, who taught me a lot. Well, thanks guys for listening. I hope you like it. Thanks for spending a little of your time with me. I apologize about my microphone. I think the next time will be better. I leave you with this remarkable phrase. That's it. Goodbye. Thank you, and see you in the next video.